Hey, what's going on, everyone? My name is Trey, and welcome to Let's Talk Finances. So, if you've been thinking about investing, and particularly investing in index funds, but you're still apprehensive or uncertain as to whether you should actually be investing in index funds, let's face it, when we're dealing with finances, it becomes very complicated, especially when we don't particularly know what we're doing. So, if you don't feel as confident as you would like to, then believe me, this is the video that you need to be watching. Now, if you know anything about me, you know that I am an active duty Special Operations Forces member, and my goal is to help you reach financial independence by getting out of debt, saving money, and investing your way into millionaire status. If this is something that you might be interested in, then go ahead and subscribe to this channel now and like the video if you feel that it's something that's beneficial to your financial future. Let's go ahead and start this video off by explaining what exactly are index funds? Index funds are a group of stocks or bonds that are designed to mimic or mirror a benchmark. So a type of benchmark would be one of the most popular ones in the S&P 500. Now, an S&P 500 index or benchmark is an index consisting of 500 of the leading or largest publicly traded companies in the United States. So, if you decide to invest in an S&P 500 index fund, know that you will own a small portion of 500 of the largest and most successful companies in the United States. And to name a few, some of those companies are Amazon, Tesla, Microsoft, Apple, and Google. That's just to name a few. So now, before we progress here, I want to clarify something that a lot of people get confused on, and that is, what are the differences between an index mutual fund and a mutual fund? See, the reason that I call it an index mutual fund is because an index fund is actually a type of mutual fund. And generally, mutual funds are going to be categorized into two separate columns, those being actively and passively managed mutual funds. Now, we're going to revisit this topic, but just for brevity, we're currently talking about passively managed index funds. Now, an actively managed mutual fund is when you're going to be paying a manager to manage your portfolio and deciding which stocks should be ones that you should or you shouldn't be invested in. So generally speaking, they're looking to get you the highest returns possible. In return, they're going to charge you a fee on the annual returns that you amass. Now, a passively managed index fund is one that is not managed by someone else. You're actually going to be managing your portfolio on your own, and because of that, you won't be paying those high fees. Now, to go along with that, you're also going to hear a term called exchange traded funds, and those are ETFs. So to make this very clear for you, all right, you're generally going to have three investment vehicles, all right? So at the very top, you're going to have a mutual fund. Now remember that an index fund is a subset of a mutual fund. So now you're going to have a mutual fund above. Below that is going to be an index fund, which is a type of a mutual fund. And below the index fund, you'll have an exchange traded fund, which is a type of an index fund. Now, the differences between an index fund as well as an exchange traded fund are very minute. So now that we know exactly what index funds are, you're going to need a little bit of help in deciding if index funds are for you. And in order to do so, we're going to need to break down the pros as well as the cons of index funds. And that's what we're about to do now. So let's jump into the pros of index funds. But before we do that, if you haven't already subscribed or liked the video, please go ahead and do so now, as it helps this channel to grow so I can continue making videos just like this one. Pro number one for index funds, and that's going to be fees. Now look, when you're talking about investing in general, you have to understand that you want to keep your fees as low as possible, because those fees take away from your annual returns, which affects your ability to build wealth in the long term. So with index fund investing, the fees are so much lower than that of an actively managed fund, and let me explain to you why. With active investing, the fees are going to be taken from your annual returns. So let's say, for an example, let's say you get 8% returns on whatever your investment is. But your manager is charging you 1%. So now you only get 7% returns because they're charging you 1%. With passive investing, you're generally not being charged as high of a fee because you're managing your portfolio on your own. And in 2022, the average mutual fund charged 0.83% for fees, to whereas the average expense ratio or fees for a index fund was 0.08%, which is a very significant difference. So let's say an individual invests $25,000 through active investing and then another $25,000 through passive investing. And he does this for 20 years while reaping a 8% returns. At the end of those 20 years, the actively managed portfolio will have made roughly about $80,000, to whereas the passively managed portfolio will have made over $92,000. Now, this is over a $12,000 difference. Now, in the grand scheme of things, most people would say, $12,000 in 20 years doesn't make that big of a difference. However, when we're talking about compound interest, the huge benefit of investing in index funds, it allows your gains from year to year to compound. So in essence, that $12,000 can reach upwards to $60,000 to $7,000 through compound interest. And for this reason, index funds are amazing. You have the ability to drastically lower your fees, which means more money will go into your investment pot. So at retirement, you can become a millionaire. Pro number 2, when we're talking about index funds, is going to be diversification. Now, when we're talking about diversification, essentially what we're talking about is not putting all of your eggs in one basket. In this particular instance, when we say don't put all your eggs in one basket, that means you don't want to be invested in only one type of asset class because it raises the volatility or risk factor for your portfolio. When you have all of your money in one particular fund, your risk factor goes through the roof. So instead of putting all of your money into one fund, what you would want to do is spread out your money across multiple asset classes. So that way, if one particular company or asset fails, in theory, you have multiple different asset classes to pick up the slack. Let's take for an example again the S&P 500. And one of those companies in the S&P 500, as I previously explained, is Tesla. But instead of just Tesla, why not invest in all of the largest, most successful companies in the United States? And that's what you will be doing through an S&P 500. And that's why index funds are so great, because you can invest your money into multiple different companies instead of raising the risk factor and investing in only one. So reason number 3 is going to be steady returns. You see, the goal, or one of the goals through passive investing, is to be able to help you earn whatever the market earns. On the contrary, when you're doing an active investment strategy, that means that you're actually trying to beat the market. And as of 2021, only 24% of actively managed portfolio handlers managed to beat the stock market. Passively managed portfolios mirror a benchmark more than actively managed portfolios beat the stock market. So in the grand scheme of things, for beginner investors, investing in index funds is a far superior, or should I say, smarter way to invest. Reason number 4, and that's going to be tax efficiency. Taxes have a major role in long-term wealth building. What we're trying to do is limit the amount of money that we're spending and increase the amount of money that we're putting away. Well, index funds do exactly that. And the reason that is, you're not going to be selling your index funds that frequently, to whereas an actively managed portfolio, you're going to be selling a lot more. And the reason for that is your ability to jump in and out of an investment. You see, when you're doing actively managed funding, the mere structure of an actively managed portfolio allows for the manager to sell and buy when it's beneficial for you. And because of that, you're going to be getting a lot more capital gains taxes. To whereas index fund investing, the whole purpose of this is going to be holding those investments for the long term. And in doing so, you will not be accumulating large amounts of taxes, i.e. capital gains taxes. Just know that you can limit the amount of taxes that you're going to be paying by investing in a simple index fund. And here's the last pro for investing in index funds: simplicity. You see, for those individuals who are new to investing, it can be very complicated. Passively managed investment strategies such as index funds makes investing so much more simpler. And the reason that is that you don't have to spend hours upon hours trying to do a market analysis and figuring out which single company you should be invested in. Instead of doing so, you can do like the great Jack Bogle, who was the founder of index funds and even Vanguard for that matter. He says that instead of spending all of your time trying to find the needle in the haystack, why not just buy the entire haystack? Investing in index funds is the best investment vehicle for not just beginner investors, but investors in general. Now, the time horizon for these investments are going to be long-term, meaning 15 to 30 years. Everything that we're doing right now should be in the wealth accumulation phase. That means we're bringing in a steady amount of income and putting enough away so that when we retire, we can actually be retired and not have to work again if we don't want to. So, if you found this video to be helpful in any way, please don't forget to subscribe as well as like, because it helps this channel to grow. I hope that you've enjoyed the video, and until next time, let's talk finances then.